Today, November 11, 2021, we're going to talk about how to trade options 5-1, a strategy called butterfly spread. It is a strategy to make money when the underlying asset price either change or doesn't change. And usually the contract price is so cheap, the risk reward ratio can up to like 30 to 50, which is a strategy that why we like it so much. And before we begin, if you haven't liked this video, make sure to shower the like button. That will help our channel tremendously and help other fellows looking get the video that they're looking for. And also, if you're interested in our paid Discord community, feel free to check out www.moneypigtrading.com. Feel free to follow us on Twitter, YouTube, and Instagram, MoneyPigTrading, to get the latest trading information. So we actually put this tutorial on our website as well, at moneypigtrading.com/tutorials. So you can look at the catalog there and looking for the link and the topic that you're interested in. So in the first video, we actually introduced a long call and long put in the second chapter. And then in the third chapter on this option tutorials, we talk about sell call and sell put. And chapter 4, we talk about vertical spread. Now we're going to talk about butterfly spread, which is a more advanced strategy. So what is butterfly spread? So basically it is a strategy to focus when the underlying asset, which could be stock or crypto, when the underlying asset is fallen into a specific range, this butterfly contract price will max out. So let's take a look on the composition of a butterfly spread. Here we're going to look at a long butterfly call spread. So basically, you will have 4 different contracts. The first one you're going to do is the lower range. You're going to have one long call option with the lowest strike price. In the middle, you are going to have 2 sell call options with the middle strike price. And the last one, you're going to have one long call options with the highest strike price. So together, this 4 contract together is going to form a range with the highest and the lowest strike price. And basically your contract price when max out is either the highest strike price minus the middle strike price. The difference will be equal to the middle strike price minus the lowest strike price, which will be the max contract price for this long butterfly call spread. And if you look at closely, it's actually the composition of combination of 2 vertical spread together. So basically 2 vertical spread combined together become a butterfly spread. So if you're betting on underlying asset will go down or fall into a range lower than the current stock price or crypto price, what you can do is a long butterfly put spread. So very similarly, you have one long put options with a lower strike price. And again, you have 2 sell put options with a middle strike price and one long put options with the highest strike price. That will make it as a long butterfly put spread. So let's take an example. Let's using the Snapchat October 22nd, 2021 expiration date, 50, 60, 70 put long butterfly spread as an example. So again, it's a put a butterfly spread. So we long one contract with Snapchat with the lowest strike price, which is 50 put. And then we sell 2 contracts. Here is a 60 put in the middle price, and a long one Snapchat contract 70 put, which is the highest strike price. Here, the max loss will be 100%. Whatever you pay for this contract, if on the expiration date here, October 22nd, Snapchat fall under $50 or above $70, this butterfly spread will be worthless. And you are going to lose 100% of this contract. Usually when you bought it, it's probably like a few cents per contract. So usually even this 100%, it's not really a major loss. So this is a good strategy for Lotto as well. However, the max profit can be very, very big because here our spread is very wide. So here 70 minus 60 in the middle contract is $10 per contract. So that means the maximum price for this contract will be $10 if Snapchat expire was traded close at $60 on October 22nd, 2021 market close. Then this contract will max out the price at $10 per contract. And the other way to calculate is the middle price minus the lower strike, which 60 minus 50 is also $10. Again, that is the max price. Usually we have a way to calculate this using the calculator online, and you can look at how it looks like. Basically, if Snapchat is traded at below 70 or below 50 or above 70, you on the expiration day, your contract will be red, worthless. You lost 100%. However, again, in the middle, if Snapchat closes at 60, your contract max at 10, that's the max price. And if you look at if Snapchat traded between 60 or 70 or 50 or 60, you are going to have some profits upon the expiration day. And you can see on the green side, that's the profit. And it looks like a symmetrical butterfly wings. And that's why it's called butterfly spread, because anytime Snapchat traded between 70 or 50, you're going to make decent money and you will max out at 60. And the profits will be on both sides between 50 or 60 or 60 or 70 are symmetrical. So for example, if we're looking at it in the flow chart next in the next slide. So the orange one, let's say Snapchat expire October 22nd at $55. Your profits will be 60 minus 50 will be $5 per contract. On the other hand, if you Snapchat expire on $65, 65 minus 60 will be $5 per contract. So either way, you're gonna get $5 per contract. So that's why it's called butterfly, like we said a few minutes ago. And let's look at this chart. So the left side is actually the y-axis, the option contract price. The x-axis is the stock price. Underlying asset price here is a Snapchat. So on the expiration day, we talk about it. Max price is at $60, looks like butterfly. And when the option price before expiration, usually you will have some time value, so you have some premium. So even though, let's say the stock price is traded at $48, or $72 where the butterfly spread is actually out of money, you're still going to have some value, this blue line, before the contract expiration day. Usually on one day before the expiration day, your contract will still have some value, even though the contract is out of money. Here is probably around 1.8. However, on the expiration day, the contract value will change drastically. If it is in the money, the price is going to change. Let's say your stock was Snapchat was traded at around $56. One day before the expiration, this butterfly probably is traded at 2.2, for example. And on the expiration day, that particular contract will jump into $5-6 very, very quickly. So usually butterfly spread, you don't really need to look at it. If you lose it, usually just a couple cents per contract, not big loss, very minor loss. And when the time approach to the expiration day, that's only the day you have to start to pay attention, try to close, take profit on that contract. So that's why butterfly spread is also called holiday trade, because you really need minimum attention once you set the trading plan and execute the order and buy the contract. So let's take a real world example here. And we mentioned about Snapchat, and that's actually one of our butterfly spread, because before the earnings on October 21st, we're expecting Snapchat is going to move very, very volatilely for either way. It can move out either up 15% should the earning report good results, or go down 15% if the earning report bad results. And if we just buy the long call and long put as a straddle, we can do that. But often the contract combination is just so expensive. Together, in this particular example, you have to put around $10 to $15 per if you have one long call options and one long put options together. However, here we're expecting Snapchat is going to move pretty wildly. So what we do is we actually buy two butterfly spread. The first one is a Snapchat loan, October 22nd, the same week, expiration day. 80, 90, 100 butterfly long call debit butterfly spread. And the contract is a lot cheaper. It's only $1.36 per contract. So if Snapchat fall into this $81 to $99, you're going to make money on this one. On the other hand, well, that's what we put in the previous slide. We loan the Snapchat the same week expiration, October 22nd, 2021, with 50, 60, 70 put butterfly spread. We got in at 1.26. So together we paid about $2.62 per contract for these two contracts together, right? And eventually Snapchat did drop into the area that we're expecting. On Friday, actually closed at $55.14. So for this particular contract, the contract price, we were able to close at $6.5 per contract. So in total, we paid $2.62 per contract for this two butterfly spread. The put spread ended up become worthless. We lost 100%, but the long call butterfly spread we actually make about 500%. But adding together, we make in total 148% on this butterfly spread lotto strategy. So really good risk reward, fairly suitable for if we're expecting a really big stock price moving or a crypto asset moving either way. And the second real world example is actually what butterfly spread originally designed for, is you are not expecting the stock price to move at all. So in this particular example, July this year, where we know the Tesla July delivery number is coming up, so nobody is really buying or selling this Tesla before July 2nd. So on June 30th, we actually got in the butterfly spread. We got in July 2nd, 2021, 60, 690, 720 cold butterfly spread, $11.5, and just trying to generate some income overnight. And overnight, because on July 1st, Tesla again didn't move and still fall into this range, and this butterfly spread actually grew in 12.9, so it gave us a pretty nice 12% overnight, better than any bank interest payment. So so just give you a screenshot in our Discord paid community. We actually got this 10% overnight, so really quick, nice profits, which is one of the butterfly most use cases what it's designed for. So at the end, we just want to highlight we actually have a small account. We're actually able to grow this account about from $1,500 at the beginning of May all the way to in July when we screenshot is about 20,000, so that's about 2,000%. Right now this account is traded around 15,000, so still about 1,000% growth, so pretty decent. And we also have a really robust Discord community that you can benefit from it. So if you're interested, feel free to check out www.moneypigtrading.com. We have Twitter, YouTube, Instagram, MoneyPigTrading. Make sure to follow. I forgot to mention about this video. So let's compare the vertical spread and butterfly spread again. So the best use case for vertical spread is when the crypto has less momentum. You're still expecting some kind of direction, either upside or downside, within a shorter time frame, then use vertical spread. Butterfly spread, on the other hand, is actually a combination of two vertical spread together, and you are using it when the stock or crypto are expected to fall into a certain specific range upon the expiration date. Both risks are relatively lower compared to just long call, long put, and way lower if you're just using a long, you are selling call or sell put. Both profits will max out on the cap, so depending on the range you select on the spread, you will max out over there. Both will require less attention compared to long call or long put or sell call or sell put. On the other hand, butterfly spread in particular really require less attention until 1 or 2 days before on the option expiration date. So we call it a vacation trade. Really don't need a lot of attention. Option contract price costs, actually a vertical spread is actually higher. I actually type it reversely. So usually it will still pay a certain amount of premium. Butterfly spread is actually the lowest option contract cost. Like previous example, you see Snapchat, the contract price is actually pretty low, and oftentimes, and that's earning, so that's why it's costing about $1-ish per contract. Usually for a regular week, a butterfly spread, regardless, even Tesla, if you don't make the spread wide, a range too wide, it's usually just a few cents per contract. So it's really, really cheap. Commission-wise, vertical spread need 2 legs, so it's 2x compared to just have a one single option. Butterfly spread would need 4 legs, so the commission cost is actually 4x instead of 2x. So the commission price will be a little higher, especially butterfly spread often we have a larger number of quantity, even though the option price is lower. So the percentage of the commission per trade is actually pretty high in this case. So this is one thing you might want to optimize is contact your brokerage and try to negotiate a lower option contract fees. So for TDM trade, you can probably, in my case, I'll lower it down to 35 cents per option contract or 40 cents per option contract. Both will require margin requirements since you have a sell put or sell call lag in both strategy. So yeah, there's a high level differences between the two. It's a longer video for a more advanced strategy. Any question, feel free to leave the comment below again, and don't forget to like this video. Thank you for watching. I'll see you guys in the next video. Bye bye.